Hi, how's it going everyone? My name is Henk and welcome back to the channel. Now we only have a few days left in this disaster of a year of 2020. We started off with the bushfires, climate change, and then we had the trade wars. And then there's this virus thing that forced everyone to stay at home, and businesses and companies are forced to shut down. And overall, it's just been an overall disaster. But what we're going to do here is we're going to take a look at the top 10 best performing companies in terms of share returns of the year 2020. So these are the companies that have kind of navigated through the difficult period and seems to have come out on top pretty well. We're going to have a look at these companies and see how their future and in year 2021 and the years beyond, and see whether or not they're still worth investing in. So without further ado, let's get straight into it. So for each of the companies, we're going to take a look at how they have performed throughout the year and whether or not this performance is likely to sustain over the coming years. So at number 10, we have Chorus. Now, Chorus is a company that operates telecommunication infrastructures. So basically, they're a company that sets up phone line and broadband services over the copper lines and the fiber networks. Now, they are one of the very few New Zealand companies that actually provide this service. And with the amount of people that are pretty much forced to work remotely or simply just stay home, people are spending a lot more time at home playing games or watching things online. And Chorus has really benefited from the increase in online communication and people having to set up their fibers and broadband. So let's take a look at the share price of Chorus. For Chorus, they have had a return of around more than 25% in the year of 2020, which again makes them quite a good return in terms of pure share price return. However, their growth in revenue has been relatively stagnant over the past couple of years, and so has their earnings. So Chorus is a company that has not been growing significantly. And again, lockdown may have quite a bit to do with that, but still they are not really a growth company. One upside is that they do have an expected forward dividend yield of around 3%, so they could be considered as a potential dividend stock. But in 2021, I would expect them to be a fairly steady company, but I probably wouldn't expect a ton of growth from the company. At number 9, we have Somerville Group Holdings Limited. So Somerville Group is obviously a rest home operator, and they build and operate various rest homes throughout the country. So their share price has a return of around 40% up for the year for Somerville Group, which again shows that they have performed extremely well despite all of the lockdowns and everything that's been happening. Their revenue has been on the increase over the past couple of years. However, if you are interested in investing in Somerville, you have to realize that you are investing in something that is heavily tied to the real estate market. So it basically, as the real estate market goes, Somerville goes. So as we all know, the real estate market is extremely hot at the moment, and Somerville definitely benefited from that. They have a very low dividend yield of around 1%, so I wouldn't really consider them as a potential dividend company stock. So in 2021, they still have a ton of projects that are either being scheduled to carry on building or being building to completion. Now, many analysts are expecting quite a big growth for Somerville in the year of 2021. However, personally, I actually expect them to grow a little bit less in terms of pure share price compared to the year 2020. Now, again, this is heavily dependent on the real estate market. If the real estate market continues on doing extremely well, Somerville can easily outperform our expectations. At number 8, we have Metro Performance Glass. Now, this is one of the smaller companies on the New Zealand Top 50 with a market cap of only around $76 million. Now, Metro Glass is obviously a manufacturer that manufactures glass products, which includes the manufacturing of double glazing glass units. Now, we all know how important double glazing glass is in New Zealand because winters here can get pretty chilly. So that is something that is definitely very necessary. So if we look at their share price from the beginning of this year, up until now, the share price has actually had a 43% return, which means they have been doing very well in terms of pure share price. Their revenue has been fairly stagnant over the past couple of years and has not really been increasing that much, while their earnings have definitely taken a hit over the past couple of years, especially in the last year, where the lockdowns have significantly affected their earnings. They're also a company that doesn't really pay out any dividends. So personally, I do not really understand where the bounce back in their share price is coming from. And for 2021, I personally do not expect them to have a massive growth in their share price. And they're one of the companies that I don't particularly recommend in this top 10 list. At number 7, we have the NZX New Zealand Exchange, the company. So what does NZX do? They obviously run the New Zealand Exchange, and they also are the provider for the KiwiSaver, Super Life, and they also run some securities and analysis for the dairy industry. So I have done a review on these guys in a separate video, so I will link that, so check that out if you haven't already. So in terms of share price, their share price have increased by around more than 40% this year. Now, in terms of NZX, as I mentioned in the other video, I don't particularly like them as a business of the service that they actually provide, considering that they has tons of troubles with security, and the fact that compared to other exchanges around the world, the New Zealand exchange just is vastly inferior compared to the other exchanges. Like, they lack in functionality, they lack in a lot of the technical stuff that you can easily get from the exchanges overseas. However, because they are a complete monopoly here, they could almost do whatever they want. In terms of earnings and revenue, their revenue has been fairly consistent over the past couple of years, and so has their earnings. Now, because the NZX isn't really a growth company, so it probably doesn't matter as much that the earnings and revenues are fairly consistent because they're providing a very similar service to their customers. However, NZX does provide a dividend yield of 3%, so they can be considered as a dividend yield stock. Looking into 2021, you're probably expecting roughly the same thing when it comes to the NZX company compared to before. You're probably expecting similar growth, similar revenue, and probably a similar dividend. So if you want a safe bet for 2021 and beyond, NZX could be a good choice for you. At number 6, we have Infertel. Infertel primarily engages in the energy sector businesses. So they have stakes in Tilt Renewable, they have stakes in Trustpower, and they have stakes in Wellington Airport, and some stakes in Vodafone New Zealand. So they're basically quite a diversified ownership group that dabbles in many different sectors. In terms of pure share price, the share price has actually been fairly stagnant for the majority of the year. So they started off the year with their share price around the $5.10 mark, and currently they're at around the $7.40 mark. Now, they had a massive jump in their share price when news came out that an Australian super fund is interested in buying out the Infertility Group. And since then, their share price has just skyrocketed up to over the $7 region and hasn't gone back down since. on the hopes that many investors hoping that they would get a deal done. But no deal has actually been confirmed yet at the moment. Looking at their income statement, their total revenue has not really been increasing that much over the past couple of years. So their revenue has been fairly stagnant. However, they did have an increase in earnings in 2019. Infertil has a dividend yield of around 2%, so they're okay dividend stock, but not absolutely fantastic. Looking over to the year of 2021, now because Infertil is quite a diversified company, I still expect them to have a reasonable amount of growth. However, their share price is mostly stimulated by the news or rumors that said that they might be bought out by another company. I don't actually expect them to have a giant increase in their share price until those deals has either been confirmed or denied. So personally, I am going to stay away from this company until that has been resolved because I have no idea which way that is going to go. At number 5, we have Scala. So this is a company that I also did a video on before. So Scala does manufacture and design of polymer products, such as the products that they use in farm equipment, and also the Scala gumboots. Now, their stock has been performing extremely well over the past year with a return of around 50%. Now, they have been performing extremely well over the past year. And people can tell me that, dairy is kind of a dying breed or company or industry, but, this is New Zealand. We do dairy here, and they manufacture equipment for dairy farming, so they're not exactly going to go away anytime soon. In terms of earnings and revenue, they have had a fairly consistent, although not particularly fast growth in revenue, and also a growth in earnings over the past couple of years, so that is always a good sign. In terms of dividend, they hold more than a 3% dividend yield for Scala, so again, they can be considered as a dividend stock. Over the year of 2021, I probably wouldn't expect Scala to have a growth of 50% in their stock price over the year of 2021. However, I do expect them to still maintain a decent amount of growth. And again, they pay a good dividend yield. So overall, I am quite liking this Scala company. At number 4, the 4th best performing company on the New Zealand 50 exchange is Fisher & Paykel Healthcare. So Fisher & Paykel Healthcare, a lot of us already know that they manufacture medical equipment used in respiratory care. Now, they're one of the companies that have done pretty well even throughout all of the lockdown that's happened in itself. So overall, their share price from the beginning of this year has gone up by around also 50% as well, starting from around $22.50 area currently to the $33.60 range. They're one of the companies that, again, least affected by all of the lockdowns that has been happening because they're considered as an essential service. Over the last couple of months, their share price has just been bouncing around in this range, and it hasn't really broken out at all. Looking at the financials for the company, they have an increase in revenue pretty much every year over the past couple of years, and also a massive increase in the net earnings over the past couple of years. So that they are a very strong company financially. They only have a tiny dividend yield of around 0.9%, so I wouldn't really consider them as a dividend yield stock. Now, in the year 2021 and beyond, what is most likely to happen is that the disease that has been going around is not going to suddenly go away just because that there is a vaccine available. There is still going to be a lot of shutdowns in many different parts of the world, and I definitely expect Fisher & Paykel Healthcare to continuously on growing very strongly in the years beyond. So for me, I am definitely bullish on Fisher & Paykel Healthcare, and I'm going to be a long-term shareholder for them. At number 3, the 3rd best performing stock on the New Zealand Top 50 for the year of 2020 is Meridian Energy. Now, most of us would know Meridian Energy already, so they basically run the power plants, the hydropower plants, and they are one of the biggest power companies in New Zealand, and they supply a ton of power and utility services to many residential and also businesses. Now, over the year of 2020, Meridian Energy started off with their share price at around $4.90 mark. And currently, they're on more than $7.80 after the recent spike in their share price. So they had a almost 60% return in the year of 2020. Now, back in around the middle of this year, news came out that they might be shutting down the TY aluminium plant, and that kind of just sent the Meridian stock kind of tumbling. But since then, it has completely rallied. And now it's pretty much performing at an all-time high level. I feel like the news of a TY plant shutdown has just become a kind of a recurring news that happens every couple of years, that whenever they want to negotiate a new deal with a power company, they just send out news that, they're probably going to shut down the TY plant. And then they'll negotiate some deal with some big electric company, and then they'll strike a new deal, and then everyone gets tons of money, and then everyone's happy again. So when the news came out that the TY plant might be shutting down, I did not really pay too much attention to that. In terms of earnings and revenue, the revenue has been increasing for the last couple of years, but it did take a dip in the year of 2020, and same has their earnings. So their earnings definitely took a significant dip in the year of 2020. And again, a lot of it is due to many businesses shutting down. They have a dividend yield of just more than 2%, which makes them an okay but not fantastic dividend yield stock. Now, I had a video talking about Meridian Energy back a few months ago that you could check out if you haven't already. Going into the year of 2021, I do not expect Meridian Energy to have such a great increase in their share price over the year of 2021 and beyond. So if you currently already hold Meridian Energy stock, you would have got it at a pretty reasonable price, and I would hold on to their stock, but I wouldn't really recommend buying a ton more at this particular high stage. At number 2, the second best performing company on the New Zealand top 50 in the year of 2020, we have Mainfreight. Now, Mainfreight is one of the biggest logistics company within New Zealand, and they pretty much operated throughout all the lockdown periods, pretty much just as normal. So they started off the year with their share price around the $42 region, and currently their share price is up to around $67. Which gives it an increase of almost 60%. Mainfreight also has really strong financials in that they consistently increase their revenue over the past couple of years and also their earnings. Now, their dividend yield is only 0.9%, so I really wouldn't consider them as much of a dividend yield company. However, they are one of the best blue chip stocks that New Zealand has on offer. Now, earlier on in the lockdown, I did a video looking at Mainfreight, and I have to say I was completely wrong in the video where I said Mainfreight is trading way too expensive relative to their intrinsic value. Now, what I did not take into account is how little Mainfreight is affected by all of the lockdown that's been going on. Looking forward into the year 2021 and beyond, I still expect Mainfreight to maintain a significant amount of growth. However, I'll probably expect a little bit less growth than the 60% growth in their share price that they experienced this year. So overall, Mainfreight, very good blue chip company, bullish on Mainfreight. At number 1, the best performing company on the New Zealand top 50 in the disastrous year of 2020 is, of course, Pacific Edge. Now, I've done a video just recently on the outlook for Pacific Edge, so you can check that out if you haven't already. So Pacific Edge does cancer diagnostic kits, and they've been shipping them overseas to worldwide clients and customers, with their main customer being in the US. So from the beginning of this year, the share price was around the 12 cents level, and currently their share price is up to around the $1.18 level, which means that they had a massive 880% return in their share price for the year of 2020. Now, that beats out the second place Mainfreight by more than 10 times. So Pacific Edge is a massive success in the year of 2020. Looking at the financials for Pacific Edge, their revenue has been increasing year by year. Their earnings is still negative, which means they're a company that's still losing money, although they're cutting down on their spendings, and analysts are expecting them to be earnings positive within the next 3 years. They're also a growth company, so pretty much all their revenue has been going back into investing into the company, so they don't really have a dividend yield yet at the moment. Now, Pacific Edge. In the video that I have released not too long ago, I have stated that I am bullish on Pacific Edge. I think they're a good company and they have a good product. In the years 2021 and beyond, I don't know if I would go as far to say that there'd be maybe a massive growth rate of 800% in 1 year for Pacific Edge. Although I still believe there's tremendous growth potential for Pacific Edge in the coming year, and I'm definitely bullish on Pacific Edge. So that's it for the summaries for the top 10 companies on the New Zealand top 50 for 2020. So just as a quick sum up, so the companies that could be good for dividend companies, so it would be Chorus and the NZX and also Scala. Blue chip companies that if you already own shares in them, that it's quite good to hold on to, including Somerset, Scala, Meridian Energy, and Mainfreight. Potential growth companies that has more room for growth in the next and or coming years include Fisher Paykel Healthcare and Pacific Edge. So doing this summary has been quite fun for me, and I hope everyone has got something useful out of this, and I will see you all in the next year. Peace.